Even a diversified investment portfolio can fail when the markets fall. In many crises, stocks, bonds, and other assets drop at the same time. When that happens, diversification offers far less protection than most investors expect. For these reasons, wealthy families often move beyond traditional financial assets. They look for a store of value that behaves differently from the financial system. One of the most interesting examples is art. My name is Shiraz Fahid and I'm the co-founder at Liquidity Wealth. And in this video, I will explain why wealthy families use art as a store of value, how it fits into structured planning, what risk must be managed, and how governance determine whether art becomes an asset or liability. Art is often misunderstood as a passion purchase. In reality, at higher levels, it functions as discrete, portable, and legally flexible asset class. When you own listed shares, the ownership exists as digital records inside of a regulated financial system. When you own real estate, the ownership is recorded in the National Land Registry. Both assets are easy to trace and are tied to a specific jurisdiction. Art works differently. A painting or a sculpture is a physical object. It can be moved from one country to another. It can be stored in specialized art storage facilities. It can also be owned through foundation, trust, or holding company. The asset does not require daily market pricing. This does not mean that the asset is hidden. Provenance records, custom documentation, and compliance rules still apply. However, the ownership structure around art can often be organized more flexibly than many traditional financial assets. For families who face geopolitical risk, currency exposure, or estate issues across countries, this flexibility can be valuable. It creates options, and in some situations, having options is more important than achieving highest financial return. At the same time, art is not liquid asset. Price depends on buyers, sellers, and market demand. Selling artwork can also involve significant transaction cost. For this reason, families usually do not treat art as a core portfolio allocation. It is normally used as a smaller store of value within a broader wealth structure. Cross-border families face situations where domicile, tax residency, and asset location do not always align. Estate tax in one country can apply to assets located in another. Probate can trigger delays even when liquidity is not an issue. Art can be structured in a way that it reduces fragmentation of ownership. For example, instead of holding a painting personally in a country while residing in another country, the asset can be owned through a properly governed entity. In Dubai, for example, structures such as the DIFC and ADGM Foundation provides regulated vehicle for holding diverse asset class, including art. These are not secrecy jurisdiction. They operate within recognized legal system with defined governance rules and court oversight. From a control perspective, arts held under a structured vehicle is easier to manage across generations than art held informally in personal holdings. Over a longer periods, some types of art have held their value even when the currencies lost purchasing power. This does not apply to all art. The quality of the piece, the ownership history, and the market cycle all affects its value. Families usually do not buy art for short-term protection against inflation. They see it as a long-term store of value that can pass from one generation to the next. A rare artwork with a clear ownership history can act as a physical asset outside of the banking system while still being insured and transferred to another owner. It is important to stay realistic. Art normally does not produce income unless it is leased to museums or exhibitions. It also creates costs such as storage, transport, and insurance. The value of art can also change depending on the market demand. Families still consider art because it behaves differently from stocks, bonds, and other financial assets. In a diversified family office portfolio, assets that move differently from the market can reduce overall risk. This is a structural decision rather than an emotional one. The situation becomes more complex when art becomes part of an inheritance. Without clear governance, families can disagree about valuation, control, or whether artwork should be sold. One beneficiary may want to sell the asset and receive cash. Another may want to keep the artwork in the family. If ownership is divided across several personal estates, managing these decisions become difficult. When art is owned through a foundation or a trust, governance rules can clearly define who makes the decision about selling the asset, who receives the proceeds, and when the artwork can be moved or transferred. Members of a council or protector can supervise these decisions. This helps maintain continuity across generations. In Dubai, regulated foundation structures allow the families to record these rules formally. The legal framework is recognized internationally. Bank accounts can also be opened in the name of the foundation, subject to normal compliance checks. This supports long-term operational stability rather than informal arrangement. Art can provide a level of privacy that many traditional assets cannot offer. Shares are recorded in brokerage accounts and real estate is recorded in land registries. Ownership of art is usually not recorded in a public national register. Because of this, families can hold significant value without creating the same public visibility that often comes with financial accounts or property ownership. The artwork itself represents the value, and the owner can choose when and how ownership information is disclosed. This does not mean that the asset avoids regulation. Storage facilities, insurers, auction houses, and banks still perform compliance checks. Provenance records and ownership history must still be documented. However, these records are normally shared only with relevant parties rather than appearing in public registries. For wealthy families, this level of discretion can be attractive. A valuable painting can store significant wealth while remaining physically stored in a secure facility and without constant public reporting. These assets can be insured, transported, sold through auction houses, or transferred privately when needed. Art also carries risk. Dispute about authenticity can reduce the value quickly. Market preferences can change over time. Poor storage condition can damage the artwork. Careful checks are necessary before acquiring the art. This includes verifying ownership history, reviewing condition reports, confirming insurance coverage, and documenting clear legal title. Professional art advisors usually assist with this process because the field is specialized. Tax must also be reviewed carefully. Capital gain rules differ between jurisdictions. Import duties or VAT may apply when artwork is moved between countries. No structure automatically removes these obligations. Tax exposure depends on residency, domicile, and jurisdictions involved. Art works best as a store of value when it is part of a wider cross-border plan. It becomes one component of a broader structure that may include foundations, trusts, holding companies, and document succession rules. Families do not use art simply because it is trendy. They use it because it provides diversification, portability, and structural flexibility when it is properly governed. If you want our help in structuring your assets, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.